A comparative economic overview of the US dollar and the Indian rupee. The US dollar, USD, and the Indian rupee, INR, are two significant currencies in the global economy, each with a distinct history, economic journey, and role in international trade and finance. Here's a comprehensive comparison and historical overview. 1. US dollar, USD, history and development origins. The US dollar was officially adopted in 1792 through the Coinage Act, replacing a mix of foreign currencies used in colonial America. The dollar was based on the Spanish dollar, which was widely circulated at the time. Gold Standard Era. From the 19th century until 1971, the US adhered to the gold standard, meaning the dollar was directly convertible to gold. This brought stability to the dollar and made it a reliable currency in international trade. Bretton Woods Agreement. After World War II in 1944, the US dollar became the world's primary reserve currency due to the Bretton Woods Agreement. The dollar was pegged to gold, while other currencies were pegged to the dollar, solidifying its global dominance. End of gold standard. In 1971, under President Nixon, the US officially ended the gold standard, known as the Nixon shock, making the dollar a fiat currency, meaning its value is determined by trust in the government rather than a physical commodity. Global reserve currency. Today, the US dollar is the world's most important currency, with over 60% of global foreign exchange reserves held in dollars. It's widely used in global trade, finance, and as a benchmark for commodities like oil, petrodollar. Economic role and factors affecting the dollar. Monetary policy. The US Federal Reserve, Fed, plays a critical role in managing the dollar's value through interest rates and monetary supply. Tightening, raising rates, strengthens the dollar, while easing, lowering rates, weakens it. Global demand. The dollar is used in most international transactions and is highly demanded in times of uncertainty or crisis, known as the safe haven currency. Trade and deficits. The US often runs trade deficits, meaning it imports more than it exports, which theoretically could weaken the dollar. However, demand for US assets, bonds, equities, keeps the dollar strong. Challenges. National debt. The US has a rising national debt, over $33 trillion in 2024, which raises concerns about long-term stability. However, due to the dollar's reserve currency status, demand for US debt remains high. Competition. Other currencies like the euro and Chinese yuan aim to challenge the dollar's dominance, though they have not yet reached comparable global status. 2. Indian rupee, INR, history and development origins. The rupee has a long history dating back over 2,000 years to ancient India, but the modern Indian rupee traces its roots to the British East India Company's introduction of a unified currency in the 19th century. Post-independence. After gaining independence in 1947, India retained the rupee but adopted a new design and denomination system, with the Reserve Bank of India, RBI, managing its issuance and regulation. Devaluations and economic reforms. 1. The rupee has undergone multiple devaluations in its history, notably in 1966 and 1991. 2. In 1991, India faced a balance of payments crisis and had to devalue the rupee, initiating a series of economic liberalization reforms under then Finance Minister Dr. Manmohan Singh, opening India to global markets and foreign investments. Float system. The Indian rupee moved from a fixed exchange rate system to a market-determined floating rate in 1993, meaning the value of the rupee is now determined by demand and supply in the global market. Economic role and factors affecting the rupee. Monetary policy. The RBI controls the money supply, inflation, and interest rates in India, which directly impacts the rupee's value. Inflation, fiscal deficits, and growth rates are critical factors affecting the rupee's stability. Import dependence. India is heavily reliant on imports for energy, oil, which is paid for in dollars. A rising oil price puts pressure on the rupee as more dollars are needed for purchases, leading to rupee depreciation. Trade and exports. India runs a current account deficit, imports exceed exports, which weakens the rupee. However, rising exports in IT, pharmaceuticals, and services help counterbalance this. Challenges. Volatility. The rupee is more volatile compared to the dollar, influenced by factors such as oil prices, capital flows, and geopolitical risks. During global crises, the rupee often faces depreciation pressures as foreign investors pull capital from emerging markets. Inflation. Historically, India has had higher inflation rates compared to developed countries, which weakens the rupee over time. Managing inflation is a key challenge for the RBI. Economic comparison exchange rate trends. 1. Over the past several decades, the rupee has steadily depreciated against the dollar. 1. In 1947, $1 equaled around 4 rupees and 16 paise, whereas, in 2024, it hovers around 83 rupees 85. 1. This long-term depreciation is due to differences in inflation rates, productivity, and economic structure. Purchasing power parity, PPP. 1. On a PPP basis, the Indian rupee is often considered undervalued compared to the dollar. 1. While the market exchange rate may be around $1 equals 83 rupees, the cost of goods and services within India makes the rupee stronger in terms of local purchasing power. Global trade. 1. Dollar. The US dollar is the world's primary reserve currency and is used in approximately 88% of all global trade transactions. 2. Rupee. The Indian rupee, on the other hand, is not fully convertible, especially on the capital account. 2. This means there are restrictions on the movement of large amounts of rupees internationally. Foreign exchange reserves. 1. India holds significant foreign exchange reserves, over $600 billion, as of 2024, mostly in dollars, which help stabilize the rupee and ensure confidence in India's ability to pay for imports and manage currency volatility. 2. The US, with its strong economy and financial system, doesn't face the same pressures to accumulate foreign reserves, as it issues the reserve currency itself. Inflation and growth. 1. US inflation. Generally low, with a long-term target around 2–3% set by the Federal Reserve. 2. India's inflation. Historically higher, often between 4–6%, though the RBI aims to keep it in check through monetary policy. Interest rates. 1. U.S. Federal Reserve. Changes in the Fed's interest rates have global impacts. 1. Higher U.S. rates attract foreign capital, strengthening the dollar. 2. RBI. Adjusts rates to manage inflation and promote growth. 2. Lower rates can stimulate growth but often lead to capital outflows, weakening the rupee. Conclusion: the US dollar and Indian rupee represent two vastly different economies. One, a global superpower with the most widely used currency, and the other, an emerging economy with a currency that has steadily depreciated but remains crucial to regional trade. 1. The US dollar is a symbol of stability and is a dominant force in international finance, backed by the world's largest economy. 2. The Indian rupee has faced historical challenges but is becoming increasingly important due to India's growing economic influence. 2. While the rupee faces volatility and structural challenges, India's economic reforms and rising prominence in global trade could lead to a stronger rupee in the future. Both currencies play significant roles in shaping global economic trends, and their interactions are key to understanding international trade dynamics.